Good afternoon, everyone. Welcome to our session today, Discretionary Risk Protection, an alternative to D&O insurance. I'm delighted that you've joined us and delighted to be joined by an esteemed panel of industry professionals. We've got Charlie Polak, Chris Overs and John Connor from Picnic. And with the invitation, their bios were sent out. I'm not going to repeat them. Safe to say that Charlie is the CEO of Uni Mutual. He's got over 25 years experience in the general insurance industry in Australia. And what that means, his youthful good looks will belie the fact that he's been around for a long time. Together with Chris Overs. Chris has over 30 years experience in the industry in various roles in claims, underwriting and management in global and local insurers. And John Connor, Chief Actuary. Like Charlie, he's an actuary. We don't hold that against him, particularly because of his extensive experience in analytics, risk management, capital modelling, pricing and reserving. So we're delighted to have all three of these very experienced professionals to take us through this topic today. I'm conscious that we have an audience who are also experienced in legal, risk and insurance, and will probably know that the directors and officers liability insurance market at the moment is in a hard cycle and is presenting a lot of challenges. We're obviously seeing increasing premiums, we're seeing increased deductibles or retentions, sometimes quite high relative to the balance sheet of organisations. There's limits on capacity, reductions in limits and terms, and in some cases capacity is being withdrawn completely. And all of this is presenting a lot of challenge for organisations as they balance the complexities of entity balance sheet protection as well as personal asset protection of directors in a market where traditional insurance is becoming increasingly expensive and in some cases unavailable to some extent. Now, there's obviously a lot of thought being given at the moment to what are the options for risk management in relation to D&O risk. The options are in some ways a bit limited. There can be changes in the structure of the traditional program that obviously will only take you so far, and so far as you change your limits or look to change the sub-limits or mix of the covers. Often changes in program structure tend to lead to the company effectively taking more risk on its balance sheet. Another option that some organisations are looking at is captive insurance. Captive insurance is probably only a realistic option for a select few organisations. It's certainly got a lot of legal and operational complexity associated with it. There's a third option, and that's mutuals, and that's really the focus of today's session. We're going to be looking at the ins and outs of discretionary risk protection structures and in particular mutuals. And what's quite interesting from my perspective is that history has shown that mutuals have been very successful in times of challenge in the market, and it's really interesting to wonder whether it's now the mutual's time to shine in D&O in the current environment. And to answer that question and many more, I'm going to hand over to Charlie and the panel. Thank you, Charlie.
Thank you, David, and thank you everyone for joining us. If you might go next slide, we would introduce the concept of what Picnic is about. So Picnic is about building self-insurance pools. So our mission is to empower individual organisations to protect themselves from sudden financial peril in a community they can trust. So the pool is a pool of like-minded members who've come together with a common goal, and that is to reduce the costs of protection. That pool allows them to fund the costs of the insurance cover, the claims, as well as then, when there's favourable experience, retaining the surplus funds either to be carried over to the future or to enhance the capital position of the pool. If we go to the next slide, we'll cover off a few of the concepts of the self-insurance pools. So we have discretionary mutuals, which is a company limited by guarantee. We have insurance mutuals, which is similar to a discretionary mutual insofar it's also a company limited by guarantee, but it's under insurance regulation. And we have aggregate deductible schemes, which can come into a couple of different forms, but maybe a managed investment scheme, unregistered managed investment scheme, which then buys group insurance. And there can be different situations where each of those is appropriate, and that depends on the members of the community, what the product is they are buying, and the potential scale of the community and considerations around overheads and efficiencies and things like that. But the key thing about being part of a decent-sized pool, self-insuring, is the concept of diversification. When you aggregate risk, the law of large numbers starts to take over, and you get a lot more stability in the total loss distribution compared to the losses that an individual would witness. If we go to the next slide, this is a very high-level diagram of just how it works. You have the pool. The members are protected by the pool with individual products where they may have their own deductible or excess specific to them. There is capital that comes into the pool initially, and then for losses which exceed the capacity of the pool, there is an insurance layer, and that would generally be put out into the global insurance or reinsurance market as relevant. But the pool manages claims up to the point where that insurance comes in, and for a lot of claims that would be below that point, they are just managed through the pool. Go to the next slide. We've got that in a little bit more detail, which shows the flow of funds. So members or customers pay contributions. Small claims are serviced straight out of the pool. The pool itself buys the insurance, and then large claims will involve funds from the pool, but also funds from the insurance layer as relevant. Where that contribution minus claims, minus insurance costs, minus overheads of operating the pool is a positive number, that is what we call experience profit, and that profit stays in the pool. So what that means is where you can reduce claims, so through risk management strategies, and moreover through just favourable claims experience by virtue of the claims being less than was assumed when the contributions were calculated, that can benefit members by retaining those experience profits. Go to the next slide. We start to dive into a little bit more about those different structures that I was talking about before. So an MIS aggregate deductible, which uses a managed investment scheme plus an insurance policy or a group insurance policy, which would be issued by an APRA supervised institution. The initial capital in that may be a loan into the MIS, and that really is funding the pool until such time as enough members have come in to, if you like, create the pool of funds. Not all the members need to come in on one day. That initial loan size depends on the nature of how high you make that point where the group insurance kicks in. So it's beneficial to have that group insurance kick in at a higher level, and that means more of the risk is retained in the pool. So having a higher initial loan size can, or initial capital size, can make that much more effective in the long term where there's favourable claims experience. The operations are managed by a scheme manager, and the launch time to get that going is typically 3 to 6 months. There is a little bit of complication there by virtue of you having two components, but importantly, the customer can furnish a certificate of currency where that's necessary. In an insurance mutual, that's probably the one with the biggest hurdles to set up. So capital is the APRA capital requirements, so potentially a higher bar of capitalisation. There's also an application process which could take well in excess of 6 months, even 12 months. And then there is also just the additional overheads of running a fully fledged insurance company, like the aggregate deductible example. You do buy, in this case, reinsurance for extreme claims or claims that are beyond the capacity of the capital plus the premiums, and you again can also furnish a certificate of insurance to anybody who needs a certificate of insurance. And importantly, you've got that contract certainty that comes with insurance that your claim will be paid if something occurs that falls within the definition of the policy wording. And then there's a discretionary mutual fund. Again, company limited by guarantee with a board of directors, like an insurance mutual. Again, you buy insurance that looks a bit like reinsurance in how it operates financially at a high level. It's regulated by ASIC only. It's not regulated by APRA. And you have a similar way of capitalising it as you would an APRA-regulated insurance mutual, but potentially the amount is a little bit less. There is also no requirement to have an additional cash capital or donationary component, might be a way of describing it. In a discretionary mutual, you can you have a lot more flexibility in that capital base, and you can fully capitalise it using instruments such as mutual capital instruments or subordinated debt, whereas APRA has very strict rules around the composition of capital. You can fully externalise the operations in a discretionary mutual, much like you can with the aggregate deductible fund model. And that means that the discretionary mutual can really have a fairly light overhead structure. So you've basically got the board of directors as the extent of the overheads and the auditing costs, etc. Discretionary mutuals and the products, the discretionary risk protection products that they issue, are described by ASIC as insurance-like, but they are technically not a contract of insurance. So if you have a product there, you are not able to furnish a certificate of insurance. And what the product buys you is the right to lodge a claim and then have the directors of the mutual consider the claim in the context of the policy wording. So you do have a policy wording similar to what you would expect in an insurance situation, but there is the discretionary component about how that wording is interpreted in furnishing or making a settlement for a claim.
Ollie,
if we go to the next,
jump in there and
yes.
I'm keen to ask you the question that's probably on the tip of everyone's tongue, which is, this is not an insurance product or not an insurance contract whereby if you meet policy terms, the insurance company is legally obliged to pay the claim. There's a discretionary element, as you've described, in the product. Now, if you were thinking about this structure in the context of D&O insurance, or D&O risk, if I might call it that, the question would be, well, how would the directors get comfort around that cover being there when they need it? What's the certainty that they get in relation to this sort of structure?
Yes, getting that certainty is obviously key to being comfortable with the protection will do what you need it to do when you need it. So there's a number of aspects of that. There is transparency around how the mutual is operated with a constitution, and members' rights are enshrined there. The capitalisation of the mutual is obviously key. You want to make sure the mutual will have the funds and the reinsurance arrangements in place, that the board won't be minded to say, oh, this claim is not in the interests of all members to pay. So the key point about that is that the directors have their own directors' duties in response to the Constitution in relation to managing the mutual in respect of all members. So each claim gets considered in the broad context of all members, as well as obviously the member making the claim. It's in the entity is in the business of paying claims. So if it does arbitrarily reject people's claims, obviously that won't go well for its reputation. But also in terms of the directors and whether they're acting in the interests of all members in rejecting that claim is a key question. In terms of the the MCIs and having sufficient capital and reinsurance. Obviously, there's a need to do sufficient analysis of an entity to make sure that the balance sheet is there and there is money in the entity to be able to respond to claims, to give you that peace of mind. And again, there's that transparency in terms of the published accounts of the mutual. And there's also the visibility of knowing who the directors are and that there's an adequate spread of member experience on the board, or director experience on the board to be, suitably managing the entity or running the entity in the interests of members. So people with insurance experience, member representatives, and so on. So there are a few aspects of that, but in terms of getting what you could call contract certainty, by definition, a discretionary mutual does not provide that. Otherwise, it would be considered insurance, fall under APRA regulation, and be subject to insurance statutory charges such as stamp duty. The other aspect of the discretionary mutual and the extent to which customers can have certainty, the situations where a claim might be considered for either rejection or not full payment, as in not 100 cents in the dollar settlement, is where payment of that claim is likely to exceed the resources of the pool plus its reinsurance. So therefore, it's incumbent on the directors to make sure that there's sufficient reinsurance limit available to that. But there is a potential situation where an extreme loss could occur, which is beyond those resources. So that's the circumstance where it's most likely that a claim would be not settled for 100 cents in the dollar. But more importantly, and potentially less relevant for D&O, but certainly for other lines of business, the key benefit of a discretionary mutual is where claims come across the desk, which ordinarily you'd say, that's not quite within the scope of the wording. The directors have the discretion to actually say, yes, we think that's in the spirit of what we're providing cover for, even though the wording might not quite cover that. We think it's fair to pay the claim, and that would be in the interest of all members to do so.
Yeah, no, thanks for that. And I asked the question knowing that there are obviously discretionary mutuals out there who provide the sort of cover, and we'll come to that a bit later. I should just at this point say to the audience that there is a Q&A function in this platform, so please feel free to pop in a question. It'll come through to me, and I can direct it to the panel as we go along. Thanks, Charlie.
Thanks, David. And you did mention there are some other discretionary mutuals in the market. So if we go to the next slide, we can see some examples of those. Uni Mutual has been in operation over 30 years. It covers universities and research organisations, civic risk and statewide mutuals, which are formed around local government. There's a few different local government solutions out there. In fact, one of the councils in Australia has its own captive, which is obviously going to the extreme. But there's also Capricorn Mutual in the auto industry, and as David alluded to earlier, Our Arc Mutual, which is run by Picnic and launched late last year, and covers religious organisations, schools, aged care, childcare, and other not-for-profits and community-focused organisations. So you can see that there's sort of distinct sort of communities there with each of those, and we would look to build out a mutual around a common community need, if you like.
Yeah, I was going to say, is that a prerequisite that you need the mutual members to be within the same industry?
That's a great question, David. Broadly, no. And the reason why broadly no is you can get diversification at scale with a mutual, which means that a mutual doesn't have to be all of the one type of thing. In fact, having all of the one type of thing might create correlations where there can be challenges. But you certainly are seeking to build diversification into a mutual. So that's diversification through scale and the law of large numbers, geographic diversification, and in some cases, product and industry diversification. So no, it's not 100% required. It is sometimes useful because then you'll get similar organizations having similar philosophies for things like risk management. So in some classes of business, risk management is especially useful. So in broad form liability and industrial special risks or commercial property, how you manage your risks in that business can make a very big difference to the claims experience. And generally, where those community members aren't really what you would call competitors, but similar sorts of organisations, there can be a really good exchange of ideas around risk management strategies and things like that, that what's worked for some and others can then pick up those ideas, and the community as a whole benefits from having a really good focus on risk management. But there are some examples where it's taken as read that everybody is being duly diligent, such as the D&O example is probably a good one in terms of boards. So you don't need to have boards from all of just one particular industry. There can be a broad selection of industries that can participate in that sort of organisation.
Yeah, no, that's interesting. And I think the risk management piece is obviously important because you've got structures within mutuals like how you deal with surpluses that can really help promote good risk management. I've got a question, Charlie. It's an interesting one, probably one that I couldn't comment on, but the question is, can you comment on a takaful insurance, which is also a pooling style arrangement for Islamic funds? I mean, yes. I know of them. I don't know the intricacies of them, but
yes, yeah. I can speak very well about them actually, because we've gone quite deep on a takaful solution for both Australia and also the UK. So I have a slide coming up in a couple of screens' time where I will speak to takaful as well. So if you don't mind, I might just hold over on that question, because yes, takaful and is Islamic principles in respect of insurance does look a lot like a mutual, and there's several different models in fact for takaful. So you have the Wakala model, which is the model that we have. We believe is the closest to how we operate mutuals and the most relevant, which is pretty much the slide which I'll show shortly. So yes, it's takaful does have relevance, and in particular for a lot of businesses where they may have a requirement for that cover, then this can be designed in such a way that a Sharia scholar can appropriately review and sign it off, and then get the appropriate certification. If we go to the next slide, I just wanted to touch on the board of the discretionary mutual. So as a company limited by guarantee, the way Picnic designs the discretionary mutual solution, you have a board of directors between 5 and 12. 5 is to align with, even though technically a discretionary mutual isn't regulated by APRA, we operate our discretionary mutuals using those prudential standards that APRA has in respect of governance and compliance, risk management and capital management, and also in terms of the roles and responsibilities in relation to directors. So APRA requires majority of non-executive independent directors. So we have a board composition which broadly delivers that. Also, APRA requires a minimum of 5 directors. So likewise, we have a minimum of 5 directors, maximum of 12. So at least 2 non-executive independent directors, at least 1 member representative director, manager representative director, which I'll come back to in a second, how the manager works in that relationship, and potentially an MCI holder representative director. So where the mutual is capitalised using mutual capital instruments, the holders of those MCIs may elect a representative to be on the board. One of the non-executive independent directors is usually the chair, and there's usually subcommittees and so forth as a normal APRA regulated board would have. But importantly, the Constitution enshrines that concept of mutuality and operation of the mutual in the interest of members. And if we go to the next slide, we can see a couple of key points here that are probably we have touched on before. That the discretionary mutual is not APRA regulated and not a contract of insurance. The discretionary risk protection product will have sections in the policy wording which look a lot like an insurance PDS, but it's technically not a contract of insurance. But the corollary to that, or the benefit of that, is that you immediately have a benefit insofar as by not being a contract of insurance, there are no insurance taxes such as stamp duty, which varies from state to state in Australia and can be as high as 9%. If we go to the next slide.
Just before you jump on there, on the contract structure, I just got a question that's come through, which is an interesting one. Obviously, traditional commercial insurance is in D&O is divided into side A cover for directors' non-indemnifiable loss, side B cover for company reimbursement, where the companies indemnify the directors, and for some products, Side C cover, usually in the listed space in relation to entity risk, client securities type risk. Question that's come through is, could you limit the mutual to a Side B and C product only, and deal with your Side A separately?
That's a very good question, and goes to the heart of some of the key benefits of a discretionary mutual. In essence, you can design a product to meet the requirements of the members. So if the members specifically require Side B and Side C cover only, then a product can be designed that specifically has those features, and not, for example, Side A if they would like to buy Side A separately. And you can potentially have different, when I say different flavors, you wouldn't want too many different flavors. Our preference is to have one broad product. But if you had a product that did have Side A versus a product that did not have Side A, for instance, that would be possible to design, and that is really part of the process we go through to design a new mutual, to figure out what is the appropriate products here for the members.
And that'll give John some pricing and reserving sort of issues to deal with, and that's where
so a good solution to that is defining the context of the risk appetite of the board, particularly for Side B and Side C claims. So whether that's limiting the risk to the balance sheet by, again, excess of loss per risk reinsurance cover. So you can design it whatever way it needs to be, and that's the beauty of a discretionary mutual fund versus insurance.
Yeah. Thank you.
And if we go to the next slide, there's a little bit that touches on that, and also goes to the heart of how the mutual gets operated. So in Picnic's model, we operate the DMF entirely on behalf of the board. So essentially the only employees of the mutual are the board members, and Picnic does all other aspects. So John described the reinsurance arrangements. There's also the pricing, the risk acceptance, the policy wording, the claims overall management and engagement as relevant of external claim assistance or administration firms, and also what products are even offered in the first place. So you can have a monoline or single class of business mutual, or you could have multiple classes, so doing D&O, broad form liability, potentially even some short tail property covers, fleet motor, that sort of thing. So you can have a diverse range of products, or just a single product focus. So certainly that's all part of, we put together a business plan for the mutual, and then consider what is the strategy of the mutual, with the objective being to, in the long term, build a mutual which is sustainable, in the sense that it is robust to the potential things that can occur from a claims perspective, market cycles, those sorts of things, and has line of sight on a scale that will allow it to achieve decent diversification and ultimately save members money.
And from a claims perspective, I guess probably there'd be some on our audience who'd be thinking, well, you've not got since you've not got insurance, you don't necessarily have some of the benefits of the Insurance Contracts Act or the General Insurance Code of Practice, or some other sort of consumer-driven insurance protections. And so from a claims perspective, there's obviously got to be a focus on claims handling and, the fairness of handling. And I guess Chris and the team would be, based on their experience, looking at, how it's outsourced, and what oversight is provided to that claims handling function.
That's 100%. Dave.
That's right, David. I mean, similar to what Charlie was indicating before, whilst it's not an APRA regulated entity, we would seek to obviously follow the outsourcing policy that's provided by APRA in that sense, as it relates to third-party claims, etc., and everything in terms of that supply line.
And it's worth noting that we certainly set internal objectives to exceed the General Insurance Code of Practice standards. And also we would seek to have the relevant performance measures in place where external administrators are used to ensure that their standards meet the requirements of the board.
Yeah, that's right. Thanks,
if we go to if we go to the next slide, this is the diagram I was referring to before when we just briefly touched on Tuckerful. So this is, broadly speaking, how the funds flow in a discretionary mutual. If you were to look at the Wakala Tuckerful model, it would look exactly the same as this, with one exception. Where that box says less insurance premiums plus insurance claims, it would be re-Tuckerful premiums. So they would be, where possible, buying its reinsurance from another Tuckerful reinsurer. So there is a thing of re-Tuckerful. There are some insurers that have, or reinsurers that have specifically set up re-Tuckerful lines. So the main difference, if you were looking to build out a Tuckerful solution, would be to make sure that reinsurance or the insurance layer is from a re-Tuckerful organisation as well, and that they've got their certification. So, but yes, the concept is that the members pay their contributions into the fund. There is an operating fee, which is generally a per member fee on the operation of the fund. The fund is in the fund monies are invested, and those investment returns are subject to tax, but the experience profit of the fund itself is not subject to income tax. So if the fund has a surplus at the end of the year, it's only the investment returns component that is taxed. And then those large claims would then recover from the reinsurance as relevant. And then obviously the claim payments go out to the members, or the subset of members, or the beneficiaries as relevant, even though the member might not be the direct recipient of the cash, the beneficiaries of the claims. And any surplus is then rolled back into the mutual fund. I've got there an additional arrow about it going to the members. Technically, you, in a discretionary mutual structure with a company limited by guarantee, you can't pay cash back to the members, but that is generally done in the form of a rebate on future years' premiums. So the contribution, or future years' contributions, so the contributions reducing by way of using that surplus to reduce the amount needing to be contributed in subsequent years.
Yeah, and I suppose that's a great example of how you encourage the members to get risk management right, but also how you can manage, I guess, year-on-year pricing sort of certainty for members. While we're sort of talking about the pool of members, do you think that there's a sort of necessary minimum, both in terms of number of members or aggregate dollar value of the fund to make these really work?
Yeah, we generally like to see line of sight on a contribution pool each year of $20 to $30 million. That gets the pool to a scale where you do get good diversification. You can have the reinsurance or the insurance layer attaching at a high enough point that there's a fair amount of risk retained in the pool, and more importantly, the amount of profit ceded to reinsurance is minimised. So that $20 to $30 million is the sort of the target we would look towards. But in terms of scale, it can be obviously considerably greater than that. But once you get to that scale, then you really start to see benefits.
I've got another question come through. Sorry.
I was just going to say something you touched on earlier about the surplus is probably also relevant. The surplus algorithm to fairly distribute surplus is a key to that calculation, and ensuring that there is fairness in the distribution of that surplus. So obviously tenure, obviously the amount of your contribution, someone contributing $1 million versus someone contributing $100,000, for example, and also the claims experience. Obviously it's generally a fairly binary claim experience, so there needs to be an appropriate weighting of the claim experience. But also, to the extent that there are other products, the depth of the relationship with the mutual, those sorts of things can all feed into that surplus algorithm, which the board approves to use for that fair sharing of the surplus.
I was just going to say that I've got a question come through which is sort of directed to where you're going with your business, and that's would you be planning to set up a DMF that would be available to ASX listed companies? But I guess it's more broadly, where would you be looking to deploy these sorts of structures?
Yeah, that's a very good question. So in respect of listed companies, there's a whole variety of different potential communities out there which we have explored potentially different solutions, and some of those companies may have requirements beyond specifically D&O. We certainly see there being opportunities there. We haven't gone into detail to plan such an entity for D&O cover at this stage. And so at this stage, we're just, well, we haven't been even actively gauging interest at this point. We're aware that there's certainly challenges in some spaces. There is a particular subsegment of unlisted companies that we're well advanced in preparing a discretionary mutual for. That subsegment are all specifically not listed companies who are a little bit different in what they do in their business compared to their peers in their industry that are listed. And that's one of the challenges there, that they have they've potentially been swept up. Where we see the biggest benefit is where companies have been swept up into an overall pricing outcome, in this case massive price increases or whatever, without proper recognition of the fact that their business might be a bit different to the average and better than the average, or even not better than the average. So in terms of specifically all ASX listed company solution, we don't yet have plans, but that's something which we can certainly explore.
Thanks, Charlie. You just got onto mute there.
Did it, didn't I? Oh dear. If we go to the next slide, we have an overall summary of the benefits for members of using self-insurance pools. And then on the slide after that, we have then just some overall summaries of some of the mutuals which either are currently live that Picnic has established or are about to go live. So specifically in the auto industry, as well as local government, there are some things coming there soon, as well as for financial institutions and financial services. You may have seen some articles recently about professional indemnity. It has similar challenges to the D&O market. So we've got a couple of different things coming down the pipeline there in those classes. So yes, there are certainly some other pools in development, some of which could be expanded to become a solution for the D&O market in particular, or alternatively, we can add an additional pool into our development pipeline specifically for D&O solutions.
Can you talk to the extent to which some of the existing pools are dealing with the D&O risk within the pool structure?
Yeah, that's a good question. So our ARC has gone live offering ISR cover to its members, or in commercial property. It's about to add a whole bunch more products, so public liability, management liability in the case of most of the members of our ARC. That's the relevant flavour, which includes effectively D&O cover, as well as fleet motor and things like that. So that's that we're expanding the product library so that as each mutual comes along, we already have the products available on the shelf. So in the case of the auto industry one, that includes D&O, PI, broad form liability, as well as the property requirements of participants in the auto industry, such as motor dealers, repairers, mechanics, as well as others that are associated with the auto industry, such as fuel companies and things like that, or petrol stations. So yeah, they have a very wide requirement for products there. In the sporting associations, that's essentially accident or personal accident cover, as well as some of the liability lines they need. In strata, it's a case of property. So yeah, there's some of them are specifically focused on, like the strata one is primarily property cover requirement, and local government has obviously probably almost the widest requirement in terms of different covers that they need. Financial institutions have specific needs around, as well as PI and D&O, potentially crime covers and things like that.
Thanks. That's it's interesting to hear that breadth of coverage just being looked at in some of those areas. I do have another question that's come through, which is asking, what about individual members topping up? So in other words, where the director is looking to take additional cover above what the company provides. I guess effectively sort of, Side A, DIC, type of cover. Do you see that featuring within the pool structure?
So to the extent, we certainly have an example of that in professional indemnity, where there's a sort of standard cover that a lot of entities buy, and there are some that seek to buy essentially an excess cover. So there is mechanism in place to be able to allow for those excess or higher limits to be available. And potentially not every member of the mutual needs the same limit in the first place. So certainly with a lot of the, for example, long-tail liability classes, things like that, general broad form liability, we might have a standard limit, but there is certainly capacity to have a higher limit in certain circumstances as required.
That flexibility, I guess, is what provides a lot of value for these sorts of structures.
Yes.
Thanks.
If we just go to the next slide, we have a summary of the members of the team, just to give you a bit more understanding of the sort of experience that we have in the team beyond the team who have joined us today. Vic, the business development underwriter, is the main person who deals with the bringing in the broking relationship and the channel relationships that we have. We also have we can operate directly with members as relevant. That's generally in the case of larger members, the way we operate. Mark, the founder, has experience in technology, and Jen has deep experience in marketing at various insurance companies as well as other financial institutions, and leads firstly the piece around branding, but also just how we go out and find members. And key to all of the experience, if you like, is Reece and the chief experience focus that he has. That means not just what you experience at claim time, but also how you experience all aspects of the touch points throughout the relationship with the mutual, the products, the way the products are presented, the way you engage in terms of digital access, not having digital access, the documents. So we have a very major focus on, if you like, moving away from some of the issues that exist with the industry currently and how they engage with their customers, and really having a key point of difference there, as well as the product differences that we talked about, but actually the customer experience differences. Because ultimately, as a customer, if you don't get to deal with the company very often, you need to make sure it's an ideal experience each time. And that's the last slide. Thank you, David. Maybe some questions.
Yeah, I'll jump in initially with some questions that sort of dear to my heart. So from a legal perspective, and in particular the Insurance Contracts Act, that obviously has got a lot of embedded consumer and policyholder protections in it. Where you're dealing with a non-insurance product, can you embed some of those protections into the coverage terms, and how do you sort of get that level of sort of consumer focus into the cover?
Absolutely. So we have a obviously focus on making sure there are no unfair contract terms in the contract. Beyond that, we have an internal dispute process, as well as through the AFSL access to AFCA and external disputes. So obviously key mechanisms for dispute, but also the members have a right to essentially submit to the board why they believe their claim should be considered if for whatever reason it has not been accepted. So there's the direct line, if you like, to the board to make those sorts of submissions. So yeah, certainly those protections, but in many cases the policy wording will have a lot of similarities to an insurance contract in that regard. So terms around payment of contribution and that sort of thing that are intended to be certainly fair, and in fact we would think better than would be normally seen in those contracts out there in the market. So yeah, that's the policy wording, is probably fair to say, is a more concise document than might normally be seen in the market. So many people will be familiar with very long policy wordings. Ours is, generally speaking, a shorter policy wording, but that in itself is reflecting the broader coverage that is usually available. In particular, the focus on limiting the policy exclusions or the product exclusions that might be there, as well as making sure that you don't have very complicated sub-clauses and write-backs and things which do nothing other than serve to confuse people. So yeah, that's a huge part of, to the point before about Reece with the Chief Experience Officer, making sure that the right information is furnished to members, and more importantly, that it's very clear, and that members feel that they understand what they're getting, because that's the key thing, making sure that the product is right for you.
Thanks. And John, I might bring John in just to sort of give that perspective from the actuarial side. So you talk about obviously the ability to have that simplicity in cover and fairly broad coverage terms. From a pricing and reserving perspective, what's the dynamic in the mutual that enables you to manage that effectively and profitably?
Yes, there's a few kind of aspects to that. I suppose the first one is the risk appetite of the mutual itself, and what new members and how it wants to design. Given they're the owners of the mutual, they can design the product how they want. There's a member representative on the board. Secondly, what that structure of that reinsurance looks like, with favourable claims experience over time, there is capacity to expand the cover beyond what they would get in a traditional 101 insurance market. So from a pricing capacity, it's encouraging good risk management within members, and usually we outline what we expect as member behaviour with regards to that specific product class. For example, in our ARC, you could have risk management assessments of the property, pipes, etc. on an annual basis, and they can be very much driven by members pushing out what they think is good practice for the industry.
Yeah.
So if you were just going through a standard insurer, you wouldn't necessarily have those approaches. They just come through in underwriting questions, and lots of them.
Yeah, I was going to say, from an underwriting perspective, and particularly, I guess, in the D&O line, would you be doing the underwriting and the question process in a similar way to what the traditional market does, or would you find a more sort of detailed analysis of the members to get their risk profile right?
We go through a data collection phase where we analyse extensively past claims experience, the information, but the context of that is to understand conceptually where the gaps are in risk and where the risks are, and relay that back to members. So it's a very interactive community.
Yeah.
So it would be similar in some contexts, but we would be collecting more data, and that's to benefit members in the future.
Sure. Just to remind the audience, there's a Q&A function. Please feel free to keep dropping in questions, and I'll throw them out to our panel. But in the meantime, from a governance perspective, I might get Chris in to sort of talk around the principles that Charlie talked to earlier around operating within a governance framework that's in line with the APRA prudential standards and GPS and CPS standards. Obviously, when you're operating in a fund or a pool that's not a licensed insurer and not subject to APRA's direct regulation, what are the sorts of controls or assurances that you put around ensuring that ongoing compliance with those standards?
It's a great question, David. I mean, looking at the governance and the board composition to begin with, I mean, clearly, they follow the APRA prudential standards, as we said, but also, where those prudential standards come from are actually from the ASX guidelines as well in terms of governance. So, from a mutual perspective, we've clearly adopted those for DMFs. We would obviously have to adopt them for a fully blown insurance mutual. But I think beyond that, you also have to look, there would normally be a constitution within which, those would be embedded. So again, members would seek comfort from looking at that mutual constitution to see that particularly around the board composition, would be satisfied, as we've said. There are accompanying documents too that would normally outline the operation of the mutual. So guideline documents that talk about, how claims are handled, how they're actually reviewed through a dispute resolution process, what sort of recourse that members can have, as Charlie indicated, further through EDR. So essentially, there are alternate documents, I think, that members can actually look at, and obviously provide comment and make changes to, in terms of the operation of the mutual, that will go towards the effective governance and operation of the mutual itself.
Yeah, that potential for the members controlling their destiny is, I think, quite important, and perhaps an interesting distinguishing feature that might see these sorts of structures start to get a lot of interest, particularly around D&O. I might sort of start to wrap things up by asking Charlie to sort of give his reflections, just as we finish up, on specifically the current D&O market, and what we've spoken about, where you think the appetite for mutuals and discretionary risk protection is likely to head in relation to particularly the D&O market.
Yeah, thanks, David. Certainly some of the more recent reports suggest that the market is starting to peak, but nonetheless it's still up a very long way from where it was previously, and importantly, the unavailability of cover is creating challenges for quite a few of the organisations out there, particularly on some of either the limits or even the availability of side C, particularly. So we certainly believe that there is an opportunity, not just in the short term, but in the long term. People we've been speaking to in London suggest that that these sorts of structures can have value in the very long term by virtue of just how a mutual recycles that experience profit. Wherever there is pricing uncertainty, it is in the members' interest to be able to retain the profit if that pricing uncertainty meant that it was ultimately a price that was too high. So we think there's certainly a long-term potential for this. Even if the market does come back down a bit, the members will have the benefit of being on the leading edge of that, because the market generally comes down or even goes up in a delayed response to claims experience. So if the market does start to come back down for insurance, D&O insurance, then it will be responding usually on a significant lag to actual experience being better than expected. So in a mutual, you get the benefit of that straight up.
And I guess it's fair to say it's probably a long-term solution. It's not something that you deal with a short-term fix. And certainly, members do potentially have, depending on the structure of the mutual and it's the constitution, the need to contribute capital should it be required by the mutual. I mean, there's obviously been instances in the past where mutuals have called to members for capital, and it's not gone well. And what are we learning? Well, what are you learning now with the benefit of that hindsight about what it means to ensure the sort of longevity and strength of the mutuals?
Yeah, the interesting point you make about the hindsight observations of those sorts of things. So we've put a lot of thought into that in how we've designed the constitution for the discretionary mutual structure. And in particular, not having that particular situation occur, and more importantly, having line of sight on capacity to get additional capital if required. So the key to that is the mutual capital instrument. So now that has become part of the Corporations Act in 2019, we've used it successfully to raise capital into our ARC. We saw Australian Unity issue 120 million of listed on ASX MCIs in January of this year. The point is that there are definitely people out there interested in investing in MCIs, and that's a key potential source of capital should the mutual need it down the track, rather than having to call on members and, as you described, potentially that not go so well. Yeah. And that's a key part of the mutual's capital management policy and procedures, strategy and documents.
Yep. I might finish off with one last question before we wrap up, which come from the audience. And I guess it comes back to what I was sort of saying at the start, which is the sort of question on tip of everyone's tongue around claims and certainty. So the question is, who manages the claims and who has the ultimate authority to decide on the grant of the discretionary cover? So I guess that claims management and sort of where the buck stops in terms of the decision.
Yeah, so ultimately the buck stops with the board. So the mechanisms in the guidelines that the board sets on how the mutual is managed contemplate how those claims get brought to the board for consideration. And certainly, yes, the ultimate authority is with the board.
Alrighty, we might leave it there. We're just coming up to 1 o'clock. Thank you very much, Charlie, Chris and John. I think that's a really interesting topic, a very topical topic in the current market. We've at Clayton Utz have had the opportunity to do a lot of work in relation to these sorts of structures and can see the benefits of them. And they certainly provide a lot of valuable risk protection for their members. I'm going to thank the audience now for their time. Hopefully we've all found it valuable. It's been an interesting discussion, and we'll leave it there. Thank you.
Thank you, David, and thank you everyone for attending.